Hello and welcome to MoneyMade. Today we're going to discuss a very important topic that everyone needs to know about: mutual funds. Whether you're a seasoned investor or just starting out, understanding mutual funds is crucial to managing your wealth effectively. So, what exactly are mutual funds? How do they work? Why should you consider investing in them? And of course, we'll clear up some common misconceptions along the way. But first, let's break down what mutual funds really are. A mutual fund is an investment vehicle that pools money from many investors to invest in various assets like stocks, bonds, or other securities. Think of it like a basket. Each investor puts in some money, and a professional fund manager invests that collective amount in a diversified portfolio. This way, each investor owns a small portion of a much larger investment. The fund manager makes investment decisions on behalf of the investors, choosing a mix of assets like stocks, bonds, or even real estate. The idea is to diversify the portfolio, which means spreading out the risk. So even if one stock doesn't perform well, others in the portfolio may balance it out, reducing your overall risk. Now that you know what mutual funds are, let's explore the different types of mutual funds you can invest in. First, we have equity funds. These invest primarily in stocks. If you're looking for potentially higher returns and are comfortable with some risk, equity funds could be a good long-term option. Next, we have debt funds. These invest in government bonds, corporate bonds, and other fixed income securities. They're considered safer but generally offer lower returns compared to equity funds. Hybrid funds are a mix of both equity and debt funds. These are designed for investors who want moderate risk with balanced returns. Finally, we have ELSS or equity-linked saving schemes. These are equity-focused funds but come with the added advantage of tax benefits on your investment. These are great if you're looking for tax savings along with wealth growth. Alright, now let's move on to the benefits of investing in mutual funds. Why should you consider this option? First up, diversification. Instead of putting all your money in one stock or asset, mutual funds spread your investment across a range of assets. This reduces the risk because even if one investment underperforms, others might make up for it. Second, professional management. Mutual funds are managed by experienced fund managers who make informed decisions on your behalf, ensuring that your money is invested wisely. Third, liquidity. Many types of mutual funds allow you to withdraw your money anytime you need it, usually with a reasonable processing time. Finally, affordability. You don't need a huge amount of money to start investing in mutual funds. With options like SIPs, systematic investment plans, you can invest small amounts regularly, making it easy to start small and grow over time. Now, while mutual funds offer great potential, they also come with certain risks which you need to be aware of. First, market risk. The value of your investments can fluctuate with the ups and downs of the stock market, which means you might not always get the returns you expect. Second, interest rate risk. In debt funds, changes in interest rates can affect your returns, especially if rates rise. Third, credit risk. If a company or government fails to repay its debt, the bonds you've invested in could lose value, leading to a potential loss. So, how do you get started with mutual funds? Let's break it down into 4 easy steps. First, define your goal. Are you saving for retirement, your child's education, or a vacation? Knowing your financial goal will help you choose the right type of mutual fund. Second, choose the right fund. Based on your risk tolerance and the time you plan to stay invested, pick a fund that aligns with your goals. You can always seek advice from a financial advisor if you're unsure. Third, you can either start a SIP, systematic investment plan, where you invest a fixed amount regularly or make a lump sum investment. SIPs are a great way to build wealth steadily over time with smaller amounts. And finally, monitor and review your investments regularly. The market fluctuates, so it's important to keep track and make adjustments when necessary. There you have it. We've covered what mutual funds are, their types, benefits, risks, and how you can start investing. Remember, investing in mutual funds can be a great way to build your wealth, but it's important to do it wisely. Always align your investments with your financial goals. Thank you so much for watching. If you found this video helpful, make sure to like, share, and subscribe to our channel for more financial tips and insights.